Every time a financial crisis hits, leaders step in front of cameras and repeat the same promise. This bailout is necessary to save the economy. Jobs must be protected. Markets must be stabilized. The system must survive. And yet, after every bailout, the same strange outcome appears. The rich get richer. The middle class shrinks, debt explodes, and inequality becomes permanent. Here's the mystery most people never stop to question. If bailouts are meant to save everyone, why do they always end up saving the same people and charging everyone else forever? Because bailouts don't just rescue failing systems. They rewrite ownership, incentives, and power in ways that almost never reverse. To understand why bailouts quietly transfer wealth upward, not temporarily, but permanently, we need to follow the money step by step, from its origins to its final destination. Stay with me, because the real cost of bailouts isn't paid during the crisis. It's paid long after the headlines disappear. Setting the stage, the promise of rescue bailouts are sold as emergencies. A bank is too big to fail. A market is systemically important. A collapse would hurt ordinary people. And sometimes that's true, at least in the short term. But bailouts are not neutral tools. They're financial interventions with long memory. To see why we have to understand what bailouts really are, they are not gifts, they are not fixes. Redistributions of risk. And the moment risk is redistributed, wealth follows. Origins: when failure used to mean failure for most of history, failure was final. If a merchant overextended, they went bankrupt. If a bank collapsed, it disappeared. If an investor made bad bets, they lost money. This wasn't moral, it was mechanical. Loss enforced discipline. But as financial systems grew more interconnected, something changed. Failures stopped being isolated. They became contagious. Single collapse could trigger panic, bank runs, and economic shutdowns. Governments faced a terrifying choice. Allow collapse and face chaos, or intervene and rewrite the rules. The first modern bailouts were framed as one-time exceptions. They never were. The rise: when bailouts became policy in the 20th century, financial institutions grew enormous. Banks merged. Markets globalized. Leverage increased. With size came influence. Governments quietly accepted a new reality. Some institutions were now so large that their failure would threaten the entire system. This is where the phrase "too big to fail" was born. And with it, a dangerous incentive. If failure would be rescued, risk became profitable. Cause and effect: how bailouts change behavior. Here's the first hidden effect of bailouts. They disconnect risk from consequence. Executives take bigger risks because losses are socialized, gains remain private. Failure is cushioned. This is not theory, it's behavior. When risk is subsidized, leverage increases. When leverage increases, crises become inevitable. Bailouts don't prevent collapse. They delay it and enlarge it. The breaking point: when the system collapses anyway, every bailout cycle eventually hits a wall. Risk compounds, debt accumulates, speculation accelerates. Then something breaks. 2008 wasn't an anomaly. It was a culmination. Banks failed. Markets froze. The global economy teetered. Governments responded with the largest bailouts in history. Trillions were created. Assets were purchased. Interest rates were slashed. The justification was simple. We have no choice. But the consequences were permanent. The fallout: where the money actually goes, here's where the upward transfer begins. When bailouts occur, money enters the system unevenly. It doesn't go to workers first. It doesn't go to savers. It doesn't go to small businesses. It goes to banks, financial markets, large corporations, asset holders. This is known as the Cantillon effect. Those closest to money creation benefit before prices adjust. By the time money reaches the real economy, asset prices have already risen. Inequality is locked in. Purchasing power has fallen. The bailout has already done its work. Why the transfer is permanent. This is the part most people miss. Bailouts don't just raise prices. They reset baselines. After a bailout, stocks rarely return to pre-crisis ownership. Housing becomes less affordable. Debt becomes normalized. Asset dependence increases. Each bailout raises the entry cost to wealth. Those who already own assets win. Those who don't fall further behind. The gap never fully closes. Failed fixes. Why reforms never reverse the damage after every bailout. Reforms are promised. New regulations, better oversight, stronger safeguards, but reforms never address the core issue, because the core issue is structural. As long as bailouts exist, risk-taking will concentrate wealth upward. Regulation can slow behavior. It can't change incentives. And incentives always win. Modern parallels, the pattern repeats. Look at the last decade. Zero interest rates, quantitative easing, emergency lending facilities, pandemic stimulus. Each intervention stabilized markets. In each one, inflated asset prices, increased wealth concentration, deepened dependence on central bank stock markets, recovered faster than wages. Housing surged beyond reach. Debt exploded. This wasn't accidental. It was baked into the design. The shocking truth about saving the economy: when officials say bailouts save the economy, what they really mean is they save the existing ownership structure. They prevent liquidation. They protect balance sheets. They preserve hierarchies. The economy survives, but opportunity doesn't reset. Why bailouts never end once bailouts exist. Removing them becomes impossible. Why? Because markets adapt to them, prices assume rescue. Risk models assume intervention. Institutions assume survival. Removing bailouts would cause the very collapse they were designed to prevent. The system becomes trapped. The quiet result: permanent upward flow over time. Bailouts do three irreversible things. They concentrate ownership. They normalize dependence. They erase the consequences of scale. Big players grow bigger. Small players disappear. Risk centralizes. This is why wealth transfer doesn't reverse after recovery. The ladder is pulled up. The repeating cycle: every bailout follows the same arc. Excess risk, crisis, emergency rescue, asset inflation. Inequality, dependency, larger crisis, repeat at a higher level. Each cycle transfers more wealth upward. Forever. 3 clear takeaways. 1. Bailouts protect systems, not people, individuals, are collateral damage in systemic rescue. 2. Risk without consequence always concentrates wealth. Bailouts reward size, not responsibility. 3. Temporary rescues create permanent inequality. What's saved in a crisis reshapes the future. Final warning, an open question. Every bailout is justified as an emergency. But emergencies don't usually repeat this reliably. The question isn't whether the next bailout will happen. The question is how much wealth will quietly move upward next time, and whether anyone will notice before it's irreversible. Call to action: if this video changed how you see bailouts, share it. Subscribe for serious, honest breakdowns of money, power, and hidden systems. Comment below: if bailouts always transfer wealth upward, who are they really designed to save? Because once you follow the money, the rescue story looks very different.